Welcome to another financially fabulous episode. I'm Limor, and I'm going to show you how to crush it with your finances. In today's episode, I'm going to be talking about what matters in a mortgage outside of the interest rates. Come on, this will be fabulous. So most of the times when we are looking to get a mortgage or renew a mortgage, the thing that we are so hung up with and so concerned is the interest rate. But the interest rate is not the most important thing, or should I say, isn't the only important thing when it comes to looking at your mortgage. I actually recently got a renewal on one of my mortgages, and the banker who reached out to me said to me, "Oh, Limor, on your renewal you could have a 2.4 or you could have 2.6. But 2.4 is much better because it's lower." And when I look at the difference of the dollar value, it's actually less than $20 different a month. $20 is nothing. I spend that on coffee or nails or all kinds of things all the time. And I shouldn't make the decision solely on that. So I actually replied asking a whole lot of questions. So here's the 5 things that I think that we should always be asking about our mortgage and things that we should know in making the decision of which is the right mortgage for us. The first thing you should ask is the mortgage portable? So if you decide to move, sell that house and buy another house, or sell the condo and move to a house, can you take that mortgage with you? Now, with some mortgages you can, and other ones you can't. And with the ones that you can, the ones that are portable, some of them are portable without needing to requalify, and those are my favorites, or what I recommend you try get if you can. And the other ones you do have to qualify for. And you may be thinking like, hey, what's the big deal? But who knows? When you move from one place to another, it may be because you are going on maternity leave and you've got a new little baby, so you need some more space. But when you're on maternity leave, you're not making the same kind of money and you may not be able to requalify. Perhaps you make a career change. Maybe you become an entrepreneur or you're self-employed, and then the mortgage that was easy for you to qualify for before, you may not be able to qualify for it. The second one is there a penalty fee, and what does that penalty fee look like if you break the mortgage? Now, for the most part, we're actually not going to be breaking mortgages. If you're going to be living in the property, you're going to pay it through till the end of the term of the mortgage. But let's say you had got yourself into a mortgage where you actually don't have the ability to port the mortgage with you to another property, and you would have to pay the breakage fee. So you want to know what that looks like. And actually, this is the reason why I was inspired to make this particular video, is because I actually have 2 specific rental properties that I am selling in the next 2 months. One mortgage is with what I'm going to call the happy bank, and the other mortgage is going to be with what I call the sad bank, and you'll see why I call them that. So with the happy bank, I'm actually selling the property inside of 30 days of the 3-year term on this particular property, since I've had the mortgage. And the happy bank has said to me, sure, no problem, as long as you sell the property within a 30-day window of actually getting to the end of your mortgage, there's no problem, we won't charge you any penalty fees. So I'm like, woohoo, that makes me really happy. That was actually what I was expecting would happen. And with the sad bank, unfortunately, I've been very, very frustrated with working with them, because with the sad bank, I'm actually selling the property 3 weeks before my mortgage renewal. So we're talking about 3 weeks on a 3-year term. And for breaking the mortgage 3 weeks before the actual renewal or the end of the 3-year term, they're actually charging me over $1,000. Just because they're saying that I'm not fulfilling the mortgage all the way to the end of its term. So I was pretty angry. I called customer service. I asked to speak to the manager. I've significantly escalated, and the most that they would say to me is, "We're so sorry, this is our policy, and we will note your complaint for future." So I was like, hurrah, super furious with that. But nothing I can do about it at this point in time. But when I got both of those mortgages, I never actually thought to ask what would happen at the end. And particularly because I knew they were rental properties that I was going to sell in the future, understanding that and factoring that money or that penalty fee actually makes a big difference. The third thing you should ask when you are looking at a mortgage is it fixed or is it variable? Now, a fixed mortgage is when it's for a duration of time, maybe 1 year, 2 year, 5 year, and you're going to have a fixed payment. So you're going to pay the same amount of money every single month, regardless of what happens to the interest rates. Variable mortgage is a little bit different in that it's based off the prime rate. So as there's fluctuations, if it goes up, if it goes down, then your payment will go up or will go down. Now it will allow you to have the benefit if it does go down, but if you're okay within a certain range, it can make sense. There's some other benefits to the variable. Sometimes breaking it is easier. So there's a number of different factors. So I'm not saying one's better or one's worse, but you need to make sure you understand which one you're getting and what are the implications of having that kind of mortgage. The fourth thing to take into consideration is prepayment privileges. That's a bit of a mouthful. Prepayment privileges. With a prepayment privilege, you're allowed to, every single year in a mortgage, pay up to a certain percentage of what your initial mortgage is. So sometimes it's 5%, 10%, 15%, 20%. But essentially it allows you, if you come into more money, whether it's an inheritance or a bonus or somehow you have more money, I don't know, you've sold another asset that you had, you can pay your mortgage off faster by making a significant payment, either typically through lump sum or it can be spread out throughout the year in order to accelerate how much equity you have and decrease the amount of time that it will likely take you to pay off the mortgage. The fifth thing you want to consider is the equity automatically being allocated into a home equity line of credit or a HELOC? So basically, when you have a property, you've got a house and you're paying your mortgage every single month, you're starting to build up equity inside of that property. And when you've got a certain amount of equity, a lot of the banks will allow you to then take money out, really essentially borrowing money from yourself. And borrowing money from yourself can actually be some of the cheapest money. And by cheap, I really mean like lower interest rate, and it can cost you less in order to be able to access that money. And so there are some mortgages, and I think this is becoming more popular, where as you start to generate or build up equity inside of your property, the mortgage will automatically convert it into a home equity line of credit. And as you pay off more and more of your initial mortgage, the more you can access the money. So if you're paying your mortgage kind of on the top end, you're taking the money out from the bottom. Now, you have to make sure that you really exercise a lot of restraint, because you don't want to use your home equity line of credit to buy new shoes, to go on a fancy vacation, but there are some instances where it can be really worthwhile. So for example, one of the things I recommend is that people use the money from their home equity line of credit as a down payment towards a next investment property, so that in actual fact that money enables you to make more money. That brings me to my tweetable today. The best mortgage for you may not be the one with the lowest interest rate. Of course, you want to have the lowest interest rate possible because you want to pay less money every single month, but there's quite a few other things that can be very costly that you need to take into consideration. That brings me to my challenge today. If you are looking to get a mortgage, or even if you have a mortgage and it's time for renewal, instead of just automatically signing on with your bank, make sure you're asking all of these great questions. Make sure you understand all the pros and all the cons of all the mortgages that are available to you and make the best decision for you. Did you like this video? Did you learn something? Subscribe to my channel, it's free, and share it with your friends. And if you want even more tips and tricks to make your finances fun and exciting, come on over to limor.money. I've got lots of great resources for you to download. Remember, I'm not here to change who you are or how you live your life. I just have strategies to make you even more financially fabulous. Thank you so much for watching, and I'll catch you next time. Till then, stay fabulous.